So starting with the startup finance. So as far as this chapter is concerned, it is divided into certain segments. In that, the first is the introduction of the startup finance, in which they have explained us the innovative 9 methods of the financing, like personal financing, financing from the family and friends, micro loan, then crowdfunding, peer-to-peer funding, like that. So they have explained us the 9 different methods. Importantly, I understand that not only understanding the individual method is important, however, looking to the questions that they have asked in examination or they have provided in the revisionary test paper, it may happen that you have to remember all the 9 methods that we have for the purpose of financing. The second is the pitch presentation that we are going to learn. Pitch presentation is something that we can say is about that how we are going to have that is how we are going to convince somebody that you finance my project. Suppose I want to manufacture a product. Let us say that I want to manufacture a machinery and I want to sell that in the market. So basically what happens that I need to convince you that this project is really viable. There is really a need of this kind of product in the market. We are going to manufacture this product and there is a gap in the market with respect to this kind of product which we want to manufacture, and that is the way I need to convince you. I need to tell you that what are my plans with respect to the production, with respect to the marketing, who are who are we, over what time period we are doing this business. All those things I need to convince you. That is pitch presentation that they have explained us. Startup financing through venture capital financing. Sources of funding. In the sources of funding, they have provided the 3 sources of funding. One is the bootstrapping. The second is that they have provided is something like called angel investors, and the third is the venture capital financing. These are the 3 things that they have provided for the source of funding. So we can say that to some extent whatever the 9 innovative ways that we have of the financing, and this point it is overlapping to some extent. Then the startup financing through venture capital financing. In that, the venture capital financing is what they have discussed in detail later on. And one more thing that they have covered is the Startup India initiative. Let's say if at all as an entity you want to take certain advantage of the Startup India initiative, by that is our Prime Minister Modi ji, then in that case there are certain conditions that you have to comply. Subject to that you will be considered as the Startup India initiative. That is what they have covered. So let us start with the very basic thing. The basics of the startup financing. The startup financing means some initial infusion of money needed to turn an idea by starting a business into reality. While starting out, big lenders like bank etc. are not interested in a startup business. The reason for the same is that the startup investors are not interested in new business. Startup involves a lot of risk, including risk for the bankruptcy and strained relationship with the friends, family, and from whom the loan is borrowed. So of course we understand that we see the number of successful ideas, but at the same time there are number of unsuccessful ideas. So it is very difficult for anybody to finance any new idea. So going to the bank and that is you ask for a loan for a new idea, then in that the bank they themselves have certain norms, and because of which they will not be very happy or they will be reluctant to give advance to you. So Persian question is to how to keep loan from the family and friends strictly business like. This is hard but part behind starting a business, putting so much at risk. But doing so is essential. It what sets entrepreneur as apart from the people who collect regular salary as employee. So basically they have provided that If at all you seek a job and you create a job, in that say there is always going to be a difference. So if at all you become say the job giver, then in that case of course you will be say different in the society also. Some important aspects about the startup: speed up operation as quickly as possible to get the point where the outside investors can see and feel the business venture, as well as understand that a person has taken some risk reaching to that level. Some business can also be bootstrapped, attempting to find and build a company from personal finances or from operating revenue of the new company. The term bootstrapping we are going to understand in detail later on. For the time being, we can say that as per the definition that they have given, it is either your own amount which you have invested, or otherwise say whatever the new venture that you have started, from that say you reinvest the earning of that business for the purpose of say taking the business to the next level. That is what we understand is a bootstrapping. They can be built quickly enough to make money without any help from the investors who might otherwise come and start dictating the terms. See, one thing is very simple for anybody to understand, that if at all I take money from you for the purpose of doing my business, then in that case of course you will have a say in my business. Even though the banks are having say a kind of clear like the terms and conditions in which they will be say charging interest, but if at all you do not make payment of the interest say for a certain time period, then in that case they will also get themselves involved in your business. Further, we understand that say there are number of terms and conditions which they impose on you with respect to raising of the further debt financing, with respect to taking up of the project say which that is has a huge amount of the investment. So of course there will be certain terms and conditions to which you have to abide whenever you are going for the outsiders financing. So in comparison to that, bootstrapping is better, wherein say you will be having say the financing with the own funds. It requires strong business plan for implementation in startup. It also requires seeking advice from the experienced entrepreneurs and expert people who might invest in the business sometimes into the future. Now here the important point comes, some of the innovative ways to finance a startup. Personal financing, in short that say you have your own amount said to be invested for the purpose of doing business. This is what say we understand is like a way by which you can even attract the outsiders funds, because when you invest, only in that case the others will have a trust upon you and say they will make investment in you. So the personal financing is of course required. Personal credit lines. Personal credit lines means something like this. Suppose that say I am doing a job in an industry, let us say for last 10 years. Over this 10 years, whatever the savings that I have, that I invest, that is for the personal financing. And during this time period, whatever my bank transactions which I have, with that say I will be able to get say certain personal loan. Whatever this kind of the personal loan which is say that which I can avail based on my these banking transactions over this time period, that is considered to be the personal credit lines. That includes even the credit line, that is say the credit card loan or certain simple kind of the loan that you can obtain for the purpose of doing this startup financing. Family and friends, that's very simple. Your uncle, your father, anybody who will finance your business, your friends. Peer-to-peer lending. So this is really a very good and innovative method of financing. We know that say a concept like Uber, we know that say a concept like Zomato, in which we understand that say the Uber is only an intermediary. A person wants to travel from one place to another place, and say somebody is there say who wants to provide the taxi services. Then in that case say the Uber is say a kind of platform at which say these two, one is the like one who is raising the demand and one who is supplying the demand, say is meeting in that is on that platform, and with that say the business takes place. Exactly the same thing is peer-to-peer funding, and as far as the crowdfunding is concerned, in which say through website you will be able to raise the funds. So whatever my idea that I have, say I have to put that say on that website, and with that say I can claim that say if at all you invest in my venture, then in that case I will give you reward say one or the other way. If it is the crowdfunding platform, then in that case I can give reward either in form of cash, that is in return, or it can be in kind form also. In a way that say suppose say that is I want to say make my own music album, then say I may approach say to this crowdfunding platform, and say from that crowdfunding platform I will be able to raise the funds say to say make my music album. Those who are investing, say to them either I can give reward in form of cash, or otherwise I can give reward in form of say the cassettes or CDs, something like that. Or if it is say an open concert that I am going to do, then for that say the entry ticket or some kind of acknowledgement, this is the way I can reward to somebody. This is what say we understand is the peer-to-peer funding and crowdfunding. Of course, over there, so the borrowers will be there, and at the same time the lenders will be there. They will come on that platform. These platforms will do the screening say for anybody who wants to come for the purpose of borrowing. See, the way we understand that say when we lend to State Bank of India, then we trust that the State Bank of India will give loan to somebody say who wants to do genuinely business, or who has genuinely an intention to make the repayment of loan. It is say Reserve Bank of India rules and regulations are there. For State Bank of India, similar to that, so this kind of online platform for the purpose of raising funds are regulated by Reserve Bank of India, and they will screen for those who want to raise the funds say through this say the online platform. Micro loan is simple, that say you take the loan say in small amount, that is a micro loan. It may happen that say if at all I approach to somebody for the purpose of the huge amount of the loan, say that person may not be ready to give the huge amount of the loan to me, then in that case say I can have, that is suppose I want an amount of rupees 10 lakhs, then say getting that 10 lakh rupees from one person may not be possible, so I may approach to let us say that 10%, 15%, 20%, and I will be able to say raise the loans in parts. This is the way I can raise the funds, that is the micro loan. Vendor financing is a method like this. It is very similar to say the car financing. Suppose I want to purchase a Maruti car, say I go to the Maruti showroom and say I select a car, that's I want to purchase this car, and I tell to that person that say I want this say car on the finance. So there is somebody who is already sitting over there as that is a finance agency who will finance me say based on whatever the like income that I have, and so with that so the Maruti company will be able to get so the release of the funds on the immediate basis. We understand that say if at all it is a Bajaj company, then the Bajaj company say will be having say its own say the financing channel. So what will happen, so the Bajaj company will be able to do on one side business also, and at the same time it will be able to get the interest so for the loan which is given to the borrower. That is what's the vendor financing. The purchase order financing, I'm just giving you some basic idea before we read like individually. Purchase order financing is something like this, that over here what happens at say, let us say that there is a company which is able to get an order from the customer. Now the company is so going to buy raw material from the supplier. Now for purchasing the raw material from supplier, the company does not have funds. Whatever this purchase order which the company has, based on that say it can approach say to a lender, asking the lender that say I have ready-made purchase order with me. So soon after I sell goods to my customer, after manufacturing it or after purchasing it, I will be able to get say the recovery of my amount within a certain time period. So I want you to finance me for the purchase of the raw material, or for the purpose, that is for the purpose of purchase of the goods. So lender will make payment to the supplier, and with that, so the supplier will supply goods to the company, and the company will be able to do for the business. That is what we understand is the purchase order financing. In case of the purchase order financing, the company is having a certain ready-made, like the orders on hand, and with that it is able to do the business in a way that it is able to get the finance. Factoring of the accounts receivable, that's very simple. We know that the factoring of accounts receivable is very similar to the bill discounting. You already have sold goods to the customer on a credit period of, let us say, 90 days. Whatever your uncollected receivable, say that you sell to a factor, your factor will make payment to you on upfront basis, say after deducting say some amount of the discount, that is interest, and keeping some amount of the reserve. Whatever at our intermediate level we have studied the factoring services, exactly the same thing is there, and with which you will be able to raise the funds. This is what we understand is the innovative ways of raising the funds for startup. So detailed discussion about above mentioned table. Personal financing. Personal financing means you invest your own savings. Suppose I am doing I start my own business after 10 years of the job. Then during this 10 years of the time period, whatever the savings that I have been able to generate, or I take, say, that is whatever the amount that I inherited from my parents, say that I invest in the business. It is not an innovative way. So they have explained it very nicely. It is not an innovative way, but still it is an important source of the finance for the startup. As outside investors are attracted more if the entrepreneur has contributed maximum amount of the funds in the business. Otherwise, investors will not be interested in investment in your business. This is very important. We know that, say, you must be aware that, say, in case of the housing property, they give loan to the extent of 80%, 90%, like that, say they give more amount of the loan. But in case of the commercial property, the bank is keeping the margin of 40%, 35%, like sometimes even 50%. Why this kind of margin is kept? The reason for that is very simple, because in case of the commercial property, there are fair chances, if at all the business is not going well, then in that case, that's the owner may not be interested to carry on the business further. That is the reason it is necessary that, say, his amount is also invested in the business. Only in that case he will do anything, say, to recover from any loss going, that is, say, if at all the business is incurring a loss, to recover from that. Personal credit line. So whatever the banking transactions that I have in past, based on that, say, I get the loan. One qualifies for the personal credit line based on one's personal credit efforts. Credit cards are a good example of this. Banks are very conscious while granting the personal credit lines. They provide this facility only when the business has enough cash flow to repay the line of credit. Family and friends. These are the people who generally believe in you without even thinking that whether your idea will work or not. However, the loan obligation to friends and the relatives should always be in writing as promissory note or otherwise. It means that the terms and conditions should be clear so far possible. Peer-to-peer lending. In this process, group of the people come together and lend money to one another, that is each other. Many small and ethnic business groups having similar faith or the interest generally support each other in their startup endeavors. Example, one vendor provides short-term lending to another vendor doing business in the same group or industry. So over here, a kind of like the credit society is what they have considered as the peer-to-peer lending. Crowdfunding. Crowdfunding is a use of the small amount of the capital from the large number of the individuals to finance a new business initiative. Crowdfunding makes the use of the easy accessibility of the vast network of the people through social media, that is website, and crowdfunding websites to bring investors and the entrepreneurs together. So it is exactly, you can say, that's a relate to the example of Uber, Zomato, wherein we understand that say basically it is a place where so the borrowers and the lenders will come at a platform, and the borrower will borrow with say certain terms and conditions, and so the investors are ready to make investment in them. Micro loan, that is the small amount of the loan. Micro loans are small loans that are given by the individuals at the lower rate of interest to new business ventures. These loans can be issued by single individual or aggregated across number of individuals who each contribute a portion of the total amount. This type of finance is similar to the crowdfunding. Vendor financing. Vendor financing, in that say you can keep the example of the Bajaj. Vendor financing is a form of financing in which the company lends money to one of its customer so that he can buy the products from the company itself. So basically they are doing two types of business. One is that say they make profit on sale of that product, and at the same time they charge interest from you. So they do business with you for two times. Vendor financing also takes place when many manufacturers and the distributors are convinced to defer the payment until the goods are sold. So the second thing that they have mentioned is that say extended credit period is provided to the customer. This means extending the payment terms to a longer period. Example, 30 days period can be extended to 45 days or 60 days. However, this depends upon one's creditworthiness and payment of more money. Purchase order financing. So when you have the ready-made order, then in that case you can get this kind of financing. The most scaling problem faced by startup is the inability to find large order. The reason is that they do not have necessary cash to produce and deliver the product. The purchase order financing companies often advance the required funds directly to the supplier. So over here the lender will give directly the amount to the supplier. This allows the transaction to complete and the profit flow up to the business. Factoring is extremely simple. In this method, facility is given to the seller who has sold the goods on the credit to the fund his receivable till the amount is fully received. So when goods are sold on the credit, the credit period, that is the date up to which the payment shall be made, is for example 6 months. Factor will pay most of the sold amount upfront and the rest amount later on. Therefore, in this way, a startup can meet his day-to-day expenses. Over here, of course, you can write something extra also. That's it can be in the recourse basis, non-recourse basis. That is a term called the factor reserve. So it is a kind of margin which is kept by the factor so as to make sure that say if at all there is any like the bad debts, or if at all it is say there is any sales return, then in that case say this amount will be deducted from the factor reserve, and with that say the amount will be finally settled. This is what we understand. Complete method of the pitch presentation. Just you have to keep in mind while reading this entire content is that you have to convince somebody that you make investment in my business. Why? Because my business is really profitable, and as an investor you will be getting a good return. That is the way you have to convince somebody, and this is what's the pitch presentation. So very first thing that you will include is brief introduction about the business that say you are going to do. it may be manufacturing of a product, it may be a trading business, it may be a kind of say the service agency, or maybe say a new kind of concept like Zomato, Uber, whenever say those kind of concepts had come into the market. The second is that say the team engaged in the business. Suppose me and say two of my friends say want to start say this kind of like startup. So what kind of experience that say we have say for doing this kind of work, what kind of qualification that say we have, that is what say the team engaged in the business. Problems to be resolved, so this is what say we have to explain that, so this is the kind of demand which is there in the market and we are going to introduce a product say which is going to solve this problem, and this is what say we understand is the problem to be resolved. For example, we can say that say like there are certain, that is say the changes which we are expecting, that say in terms of the environment. So if at all I am going to manufacture a product say which is going to say create say the environment friendly say certain products, then say it is say going to make a sense in future. Fourth is that say whatever the problem that say we have, for that say we are going to provide a solution. How we are going to market our product, what is our sales plan, what do we have the projection and milestone. In that always you have to make a good story, only in that case anybody would be interested. Competition, who are there else in this kind of business and what kind of achievements that say they have made so far. The business model, how you are going to have the entire structuring say of your business. And the last is the financing that say you are expecting from the opposite party. And of course over here, so the sequence in which they have provided, so that sequence has to be maintained. Over here you cannot break the sequence that say they have provided. That is say the brief introduction of the business, team, problem solution, marketing, projection based on that, competition, business model and financing. Short and the brief presentation to the investor explaining about the prospects of the company and why they should invest into the startup. A quick overview of the business plan and convincing the investor to put money into the business. The second is the team engaged, introduce the audience, the people behind the scene. The investors will want to know the people who are going to make the product or the services successful. Also an attempt should be made to include the background of the promoter and how it relates to the new company. Moreover, if possible, it can also be highlighted that the team has worked together in the past and achieved significant results. Problems to be resolved. Further, the promoter should be able to explain that the problem he is going to resolve and the solution emerging from it. Further, the investor should be convinced that the newly introduced product or the services will resolve the problem convincingly. Example, Facebook resolved the problem of the profile access to the people. This feature was lacking in Orkut. Orkut was say one of the social media platform say earlier. Solution, it is very important to describe in the pitch presentation as how the company is planning to resolve the problem. Example, Flipkart introduced cash on delivery to solve the problem of the payment through credit card which was not available before e-commerce sites. The second problem, Flipkart addressed the problem of on-time delivery by launching their own supply chain management system. These innovative techniques used by the Flipkart enable to raise the large amount of the capital from the investors. Marketing sales. This is very important part where the investors will be deeply interested. The market size, this is something which is important, of the product must be communicated to the investor, and over the last let us say that say you can give the last 4 or 5 years details, let's say how this kind of say demand for this kind of product is increasing in the market. So what is the future demand? This can include the profile of the target customers, but one should be prepared to answer the questions about the promoter is planning to attract the customers. The promoter can also brief the investors about the growth and forecast the future revenue. Projection of milestones. It includes 3 basic documents that make up the financial statement. So 3 things are required. One is the income statement, second is the cash flow, and third is balance sheet. All the 3 documents should be on the basis of the future estimated figures. Competition. It is necessary to highlight how the products or the services are different from their competitors. If any of the competitors have been acquired, their complete details should be highlighted. Business model. In that, so they have provided a small example also. The term business model is a very wide term denoting the core aspects of the business, including the purpose, process, target customers, offering, strategies, infrastructure, organizational structure, sourcing, trading practices, operational processes, policies, including culture. All these things are required to be mentioned. As per Investopedia, a business model is a way in which a company generates revenue and makes profit from the company operation. Example, there are 2 companies A and B. Both of them are engaged in the business of renting movies. Prior to the advent of the internet, both the companies rent movies physically. Both the companies made 5 lakh rupees as the revenue. COGS was 4 lakhs. So both of them had income of 1 lakh. So the companies made a profit of rupees 1 lakh. After the introduction of the internet, company A started the offer moving online instead of renting or selling it physically. This change affected the business model of A positively. Revenue is still 5 lakhs, but the significant part of the COGS is now 2 lakhs. This is because online sales will lead to significant reduction of the storage and distribution cost. So the gross profit will increase from 20% to 60%. Manager of company A have additional 40% more in the margin to play with the managers at company B. Managers of company A have little room for error and they have to tread carefully. It is better to know the investors a list of the various revenue stream for a business model and timeline for each of them. It is also beneficial to discuss lifetime value of the customer and what should be the strategy to keep them glued to their product. Means how you will be able to generate the recurring revenue from the customer. That is what you have to explain them. Financing. If a startup business has raised money, so already you have raised funds, it is preferable to talk about how much money has already been raised, who invested the money into the business and what they did about it. If no money has been raised till date, an explanation can be made regarding how much work has been accomplished with the help of minimum funding that the company is managed to raise. It is true that the investors like to see the entrepreneurs, this is important, who have invested their own money. If a promoter is pitching to raise the capital, he should list how much he is looking to raise and how he intends to use the funds. And friends, I do not know whether you have made any project report or not. In any of the project report that is prepare, in that always you are required to separately mention how much the promoters are going to contribute, how much directors are going to contribute, and definitely the financial institution or any bank will make sure that you are not allowed to withdraw anything unless say my full amount of the loan is repaid. So this is what say we have the financing. Now as I told you that say the first point and the third point are say almost say overlapping to some extent. So modes of financing for the startup, in that say they have provided one, bootstrapping, second, angel investors, and the third is venture capital funds. They have asked all these three questions in examination. Bootstrapping is also there, angel investor is also there, and venture capital funds is also there. In bootstrapping, wherein we understand that say you have your own amount to be invested, or we understand that say you reinvest the funds that say you earn from the business, is bootstrapping. In that say they have provided three things: trade credit, factoring, and leasing. How in bootstrapping they have provided these three things that I am explaining to you. Angel investor is a separate point, and venture capital funds, in that say the domestic and offshore funds. That is what say they have provided. Venture capital financing is what they have discussed say quite in detail. As per my understanding and looking to the examination questions and the questions from the revisionary test paper, you don't have to remember all these things together. You will be required to remember that when the question comes of the bootstrapping, you have to remember these three things properly. Angel investors question will be there, and in venture capital funds, if at all there is a general question with respect to that say what kind of the venture capital funds are there, in that say you have to remember this. So let us start with the very first, bootstrapping. See over here, I can say that say they have provided a certain explanation like this. They have provided an explanation that say if at all you are starting a new venture, you are starting, that is your startup business, then in that case initially you do not become too much optimistic and you do not make say the too much investment in your business, because if at all more and more amount of the capital is invested in your business, with that say the risk will increase. So you should try to reduce say the initial advertisement expenses. You should try to reduce say the capital expenditure so far possible. Whatever the financing that say you have, say that might be blocked in fixed asset. So instead of say purchasing of any fixed asset, you try to say take the asset on the lease. That is what say they have explained. Second thing, that say the stock, in which your major amount of the funds will be blocked. So instead of purchasing the stock on cash, you try to get credit from your supplier. You give a presentation to your supplier. You try to convince your supplier that say in future I will give a good business to you. Since it is my initial business, say don't expect me to pay early, or say you give some more like the time period for me to make the payment to you. You talk to that say the chief financial officer. If it is a small business concern, then you meet with the owner. Your communication skill and everything will make a sense at that point of time. That is the way you should be raising the funds. So that is what say they have considered in trade credit. And at the same time, so whatever the funds which is blocked in the business in form of debtors, so that you should release say by way of factoring. This is what say they have explained in terms of the bootstrapping. So when the point of the bootstrapping comes, you have to keep in mind, one, say the financing of the business with your own funds. Second, reinvestment of your own, that is a reinvestment of the earning in the business. Third, initially do not say over invest, or initially do not make too much advertisement expenses, or do not commit your funds in the capital investment. Instead of that, what you should do, you should acquire the asset on lease. So you have to make minimum amount of the investment. You should get the credit from your supplier with one-to-one negotiation. You try to convince your supplier. That is the second thing. And the third thing that say they have provided is that say you should not allow your funds to block in the business in form of debtors, and you should get it released say by factoring the accounts receivable. So keeping all these things in mind, let us read now the content. An individual is said to be bootstrapping when he or she attempts to found and build a company from personal finances or from operating revenue of the new company. So this basic definition has to go like one on one. In that say there is no like excuse, I think is acceptable. A common mistake. So now they are explaining us that say these are certain mistakes that say you do. So let us overcome that say by doing these three things. Made by most founders is that they make unnecessary expenses towards marketing, offices, equipment they cannot really afford. So it is true that the more money at the inception of the business leads to complacency and wasteful expenditure. On the other hand, investment by the startup from their own savings leads to conscious approach. It curbs wasteful expenditure and enable the promoter to be on their toes at all times. So this is the kind of problem that say you will be facing. An individual should have appropriate budget for expenses to be made in initial stage of the startup, as there is lack of the funds in the initial stage. Here are some of the methods in which the startup firm can bootstrap. So they have provided the three solutions to this kind of problem that say you can have. The first is trade credit. When a person is starting his business, suppliers are reluctant to give credit. They will insist on the payment of their goods supplied either by cash or by credit card. However, a way out in this situation is to prepare a well-crafted financial plan. The next step is that the plan should be communicated to the supplier directly or through employees. Communication skills are important here. The owner or the financial officer has to be explained about the business and need to get the first order on credit in order to launch the venture. So your own amount will be less invested. Ultimately the logic is that the owner or the financial officer may give half the order on credit and balance on the delivery. So at least if at all the half of the order is say received by you on the credit, you manufacture the goods from that, you supply it to your customer, you get the payment, and then you start rotating the funds. The trick here is that to get the goods shipped and sell them before paying to them. Through trade credit, one can reduce requirement of the working capital and also interest costs on such working capital. This is especially true in case of retail operations. Explain the detailed plan to respected authority and elaborate the needs of the credit first order for the startup. Factoring. Same thing that you have to mention what we have recently understood. This is a financing method where the accounts receivable, that is debtors of the business organization, is sold to a commercial finance company to raise capital. The factor then got hold of the accounts receivable of the business organization and assumed the risk of the collecting the receivable as well as doing what would have been a paperwork. Factoring can be performed on non-notificational basis, so your customer is not aware. It means that the customers may not be told that their accounts have been sold. The factoring reduces the working capital requirement of the business, which reduces the overall cost of the organization if the block funds and the operating expenses are also reduced. We know that there are certain advantages of the appointment of the factor as: one, your collection expenses will be reduced. Second, your blockage of the funds will reduce because you will be able to get the recovery fast. Then you will be able to focus on your core operation. With that, the sales of the business will increase. These are the advantages that you have. But of course, nothing comes free. you have to make the payment of interest, you have to make payment of the factoring commission. Leasing. Leasing is something that say we know that say you acquire an asset on the rent, so you don't have to invest. Another popular method of the bootstrapping is to take the equipment on lease rather than purchasing it. It will reduce the capital cost and can help the lessee, the person who takes the asset on the lease, to claim tax exemption. It is better to take the required fixed asset on the lease to avoid paying out lump sum money, which is not at all feasible for startup organization. And of course, over here you can definitely mention certain additional points that say from the leasing company point of view, there will be an advantage of claiming depreciation as an expense, so we'll get the tax saving. If at all the leasing company is able to raise the funds at the lower rate, then in that case it can definitely pass on so that advantage say to the the company who is going to use the asset, that is lessee in our example. From the lessee point of view, whatever the lease rental payment that it is making is allowable expense from tax point of view, and you can get the tax advantage of the same. Next is angel investor. Now angel investor and venture capitalist, both of them are one and the same. However, the angel investors are those investors say who are not going to scrutinize your business plan rigorously and they make investment in you. That is what we understand is the angel investors. Angel investors you can find on the crowdfunding platform. Angel investors you can find on the peer-to-peer funding platform. That is what we understand is angel investors. Whatever the loan that say you are able to get from your family, say from your friends, that is also angel investors. As per Investopedia, angel investors invest invest in small startup or entrepreneurs. Often angel investors are among an entrepreneur's family and friends. The capital angel investor provide maybe one-time investment to help the business propel, drive or push something forward, or an ongoing injection of the money to support and carry the business through through its difficult early stages. So it can be say like one-time investment, or it can be say injection of the money to support and carry the company through the difficulty stages. Angel investors provide more favorable terms compared to other lenders, since they usually invest in the entrepreneur starting the business rather than the viability of the business. So if at all any of your family member is investing in your business, then in that case not that idea is very important for them, but say you become financially independent or you prove yourself is more important to them. Angel investors are focused on helping startup to take, that is say startup take their first step, rather than the possible profit that may get from the business. Essentially, angel investors are opposite of the venture capitalist. So venture capitalists are like they are going to do hardcore investment, wherein they will make sure that say whether your business plan is good or not, they are going to do a proper scrutiny of the same. Not only the investment is given and then the story is over, they will constantly monitor also your, that is say the business progress. They will say interfere in your business investment also if at all your business is not going well. Angel investors are also called informal investors, angel funders, private investors, seed investors or business angels. These are affluent individuals who inject capital for startup in exchange for the ownership equity or convertible debt. Some angel investors invest through crowdfunding platform online or build angel investor network to pull in the capital. Angel investors typically use their own money. Unlike venture capitalists who take pull of the money from many other investors and place them in strategically managed funds. So basically, in case of the venture capital, what will happen? We can say that it is a kind of the mutual fund concept, wherein say you take funds from the different investors and then you make the investment. Whatever the return that say you generate, so that the return is passed on to the investor. This is what in case of the venture capital. So in that, of course, you will be having a responsibility set to those from whom you have borrowed funds, in a way that say you have taken funds with a kind of an assurance that say I will give return to you. But in case of the angel investors, it is their own funds only. So they use their own money. Though angel investors usually represents individuals, the entity that actually provide the fund may be a limited liability company, business, trust, or an investment fund, among any other kind of the vehicles. Angel investors who seed means that say they provide funds. Startup that fail during the early stage lose their investment completely. This is why professional angel investors look for opportunities for defined exit strategy. Exit strategy means, say when you make investment, the business is very small. It may happen that say the business will grow after 5 years or 6 years. Now you want to sell off that investment. That is what we understand is the exit strategy. This exit strategy is what we are going to discuss in the venture capital financing also. Exit strategy is something wherein we understand that say you will sell your own equity investment say to the promoters of the company, or otherwise say if at all that the entire organization is being purchased by somebody, then in that case you will sell your investment to that new promoter. If it is going into the, let us say that it is converted into a public limited company, then in that case you will sell your holding to the public. That is what the exit strategy. Acquisition or initial public offering. So we can say that say over here, the first point in which say they have given us an explanation about the angel investors, that it can be your family, it can be your friend or any other investor who provide one-time investment or injection of the money to support and carry through the difficult stage. Second point is that say they will be providing say the funds on the more favorable terms in comparison to the venture capitalist. Third, you will be able to get the funds through crowdfunding platform or informal investors, angel founders, etc. Importantly, they will invest their own money. It can be individual, limited liability company, trust, and they will have say an exit strategy. So these are the 6 points that say they have included. So again the same modes of the financing. In that say the bootstrapping is done, angel investor is done. Now we are going for the venture capital funds. Concept of the venture capital fund. Venture capital is money provided by professionals who alongside management invest in young, rapidly growing companies that have potential to develop into significant economic contributors. So ultimately over here, basically venture capital is a kind of like we can say a mutual fund, wherein so the funds are invested say by the investors and they will screen the different investment opportunities. So those who want to start up their startup, they have to approach to this venture capitalist asking that say we have say this kind of like the pitch presentation is required to be given to them for the purpose of raising of the funds. And if at all they feel that say your business is really worth, then in that case say they will make investment. Venture capitalists generally finances new and rapidly growing companies. They will definitely make investment in equity. They are interested in high return, and high return is possible only if they take high risk. So always the investment is going to be for the long term purpose, and the investment is going to be in the equity only. And importantly over here, so they are not going to provide that is funds only for once. They are going to provide the funds on the regular basis also in future. Assist in development of the new product or services. Since they are basically into this business and they might have, say, finance number of such concerns, so they will be able to give you an assistance, they will be able to give you a help that, say, you will be able to, say, get growth in your business also. In a way that, say, whatever the kind of difficulty that, say, you are facing in your business, that you can discuss with them and they can provide a solution, say, to that problem. Why? Because they have that kind of experience, say, of managing, say, this kind of situation. Add value to the company through active participation, and at the same time, say, they will be able to, that is, give you the like the network advantage. Whatever the entities to whom that, say, they have provided financing, so internally also they will be able to give business, say, to one another. Characteristics of the venture capital financing: long term horizon, generally 3 years to 10 years. From the investor point of view, there is lack of liquidity. If at all the venture capitalist wants to redeem their investment, it is very difficult for them to convince now somebody that, say, you make, that is, say, you purchase my equity shares, unless, say, that the entity in which the investment has made has really grown to a certain stage. So from the investor point of view, there is lack of liquidity. Very high risk from the investor point of view. It works on the principle of the high risk and high return. Always equity participation. Ventures can control the company by investing in equity component of the company. Advantages of that is bringing venture capital into the company. So from the company point of view, or we can say that, say, from the startup point of view, what are the advantages if at all I get the venture capital finance? It injects the long term equity finance, provides a solid capital for the future growth, so you will be able to take the chance. If at all your business is falling down, don't worry, still you have a time to recover. Why? Because you do not have the fixed financial charges commitment. You don't have a commitment, say, for the purpose of redemption of the debentures. That is the reason, so you will be able to take the chance. Venture capitalist is a business partner, sharing both risk and the reward. Venture capitalists are rewarded with the business success and the capital gain. The venture capitalist is able to provide the practical advice and assistance to the company based on past experience with other companies which were in the similar situation. So if at all you are facing a certain trouble, then in that case you can discuss the same with the venture capitalists and they can provide a solution to it, because they might have seen this kind of same situation that other companies might have faced in past. Venture capitalist has a network of the contacts in many areas that can add value to the company. It may be capable of providing the additional round of the funding should it be required for financing the growth. You already have reached to a certain level, and now for further growth, for further expansion, for acquisition of any competitor, you require funds. Then in that case, the venture capital can provide you further funds. This is what, say, one of the additional advantages that you have, and you already have established a trust, say, with the venture capitalists, because you already have grown to a certain stage. Venture capitalists are experienced in the process of preparing a company for the IPO of its shares on the stock exchange or overseas stock exchange such as Nasdaq. So what happens, that, say, if at all you want to, say, get listing then in that case say they will help you even in that, because even they want to say exit. It can facilitate a trade sale. Trade sale means that say your ongoing business will be sold to somebody. So these are the advantages, and of course like these advantages you are required to mention very precisely, and you can prepare your own head points for that is said to remember from examination point of view. Solid capital for the future growth, risk and reward, advice for assistance, network, additional round of the funding, company for IPO and trade sale. Stages of the funding for the venture capital. The first is seed money. Seed means seed has like simple beach, that is called seed. So seed means say from the very beginning, so whatever the funds which is required, very low level of the financing needed to prove an idea. Startup, early stage where the firm need funding for expenses associated with the marketing and product development. First round, early sales and manufacturing funds. Second round, for working capital early stage companies that are selling product but not yet turning into the profit. Third round, also called McGinney's financing, that is expansion money for a new profitable company. Fourth round, called bridge financing, intended to going public process. That is what we have. See a question asked in January 2021, question number 4C. Venture capital funding passes through different stages. Seed money, startup, first round, second round, third round, fourth round. This is a suggested answer, even that's it, this is what they have provided. So you need to not only understand the seed, startup 1, 2, 3, 4, but internally also you are required to write the relevant portion, what they have mentioned in the first round, second round, third round and fourth round.